the real world and financial markets. If you look at the American stock market, you find that it's practically booming, and if you're not aware of the history, you will not think that it has been affected by COVID at all. But it is a disconnect from the real world, where factories are just starting to open, airlines are not operating at near full capacity. Okay, let's go on to palm oil. It has been a tough year for most commodities, palm oil included. We had the beginning of the year, the spread of COVID in many countries. Lockdowns has affected palm oil also, especially the labor situation, where a lot of Indonesians working in Malaysia had to go back and had not been able to support the palm oil industry. We had demand destruction. Crude oil crashed has also affected palm oil. Okay, and it has also been affected by the palm oil gas oil spread. Right, gas oil and palm oil have been used in biodiesel. So if the price of gas oil is cheaper, less palm oil is used, and more gas oil in blending of biodiesel, especially in Europe. Okay, next we look at the crude palm oil spot chart on the OTC market for the period of 20 years. You'll find that palm oil has not done that badly as compared to most other commodities. Historically, the price has dipped not too badly as compared with the previous dip of previous years. Over the long run, palm oil has practically traded from 1,000 ringgit per ton to 4,000 on the fiscal market. Trading crude palm oil, you can't get away from its other competitors, especially soybean oil, sunflower oil, and rapeseed oil. And from the illustration in this chart, you'll find that most of them moved practically in tandem. But when China closed down, you find that all the prices were coming down. Then we had crude oil crashed, which depressed all the edible oils further. And then we had the lockdowns. And after the lockdowns are over, it bottomed out, and most of the prices have recovered. And you find the palm oil price recovering the slowest. The main competitor for palm oil is soya oil. Most of the soya oil comes from Argentina and Indonesia. So if you look at the two charts, you find that they are practically used as substitutes. If one becomes too expensive, the other is used primarily in industry as well as for consumption. And this chart shows the soybean trend both in the US as well as in Argentina, Brazil, and Paraguay. The production in the US is also important for palm oil, especially because once China starts buying more US beans, it will, of course, reduce its buying of crude palm oil. Okay, if you look at the consumption of crude palm oil, you'll find that primarily most of it is actually used for edible oils, and this portion here, about 23%, is used for biofuel. So these two are the key to palm oil, the edible portion as well as the biodiesel portion. And traders would pay attention to both of these sectors and how drivers of commodities affect these two sectors. If you look at this projection from the oil world, you find that the forecast for palm oil world consumption has fallen down in this year. Okay, but the projection going forward is the use in oil consumption will increase as the lockdowns ease, and China will buy more beans, and so would India. And they will especially buy from Malaysia as the prices are relatively cheaper compared to Indonesia. Next, you need to pay attention to the B20 and the B30 programs. B30 is an Indonesian mandate for blending 30% of palm oil into fuel, and for Malaysia it's the B20 program, which blends 20% of the palm oil into biofuel. But one demand for COVID expected is the use of palm oil in hygiene products, which will continue to soar. And the next thing is that oil seed production in Europe, which primarily the rapeseed oil and sunflower, which is often used as a substitute for palm oil in biodiesel. And the production is, we feel that it's not going good, so it bodes well for palm oil. Biodiesel, as I mentioned, is the key to palm oil prices. Although because of COVID-19, the B30 program is going to used up a little bit less from the 9.6 kiloliters projected in the beginning of the year to 8 million. Okay, then we have the B20 program mandate in Malaysia. It's on off, it's supposed to start in September. Let's see whether it goes ahead. But if it goes ahead, it's going to be very supportive of palm oil prices. It's going to use up quite a bit of palm oil from the market. Palm oil, petroleum prices are also quite critical for palm oil because of the biodiesel element, especially gas oil. Higher gas oil prices will reduce the discount to the crude palm oil and maybe revive the blending of palm for biodiesel. Currently, with the low price of gas oil, less palm oil is used. Production is going to be poorer for palm oil this year. The last quarter last year, we had a dry season. There has been less fertilizer that is being used by farmers. So we can expect a delayed effect in the yields. This season is primarily a high production season for palm oil, but the yields are, as I mentioned, is going to be lower. Indonesia's production is also going to be lower by 1 million to 2 million ton, and output is going to be dropped because of stress on trees. And we also have labor problems in Malaysia. Okay, we have the global oil and fats numbers, a lot of figures there, but just look at the last column here, the forecast for 2020. Opening stocks, of course, is forecasted to be down. Production is down for all the oils. Imports, of course, down. Exports down. Consumption also down. But which, of course, in the end results to the ending stocks, which is higher. And most of us used a ratio called stocks to use ratio, which often tells us a story. Primarily in commodities itself, if we, for each commodity, if we have the higher stocks to use ratio for commodity, it primarily means that there's not really going to be a bull run for that commodity itself. You can check up the prices for 2016. The palm oil prices were high. That particular year, the stocks to use ratio was practically lower comparatively. Last year was also lower. Okay, this is from the oil world, especially this is only for palm oil. We have stocks to use ratio for going forward, the 2021 season, which is slightly higher than forecasted earlier. What it all means is this. If you look at the stocks to use ratio, and this is from the Malaysian Palm Oil Council, they have given 3 projections. The average one is where palm oil is trading now. Then we have a low projection if crude oil prices go down and demand drops in major consuming countries, India, China, EU. That is, we are looking at almost 2,000 ringgit per ton. On the high side, we have if the biodiesel mandate B20, B30 go as planned, and a lot of palm oil is taken off the market, and we do going to have lower oilseed production. We are looking on the high side of palm oil prices this year at almost 2,006 per metric ton. And here is basically the SUR chart, is stocks to ratio chart, where over the years, and this is what has been forecast for this year. So what it means is don't expect prices this year to go higher than last year's prices. Let's look at the chart of palm oil. Of course, we have forecast a peak of almost 2,600 ringgit per ton. Okay, but that is dependent on a few things. If China buys US soybeans, okay, we expect that. If they don't buy China's soybeans, they will buy more CPO, which will be good for the price, and the price might go higher. Next, the relationship between India and China has been patched up, but it's a political thing, so do watch out for that. And next, recently the Australian Weather Department has raised the ENSO outlook to La Nina. ENSO is the El Nino Southern Oscillator, which is a weather phenomena that develops in the Pacific and affects weather patterns around the world. They have said there's a 50% chance of the weather ENSO La Nina forming. So what it means is that there's going to be a wetter weather in Malaysia and Indonesia in the southern hemisphere spring. Springs is from 1st September to end November for the southern hemisphere. So if we have wet weather program, it will affect logistics in Malaysia and Indonesia also. So that's the forecast for palm oil. Let's look at crude oil. There's some key points that are, have been listed. We know that palm oil has been consolidating for the past 1 or 2 weeks, around $40 a barrel for the WTI. It has shut off from practically zero, and it is due for short-term market consolidation. The market is worried about the demand recovery due to the spread of the coronavirus, especially in the US. And then there is OPEC output compliance issues, which has not been the healthy previously, although we have news that OPEC is going to comply with their output agreement, which will be good for crude oil prices. Refinery margins also likely to have a short-term correction because as economies started to open, refineries started their business, and I think the output has increased beyond what the demand recovery needs. But the path to rebalancing by OPEC is, I think it's going forward, but the path is not going to be smooth or in a straight line. But overall, the market seems still to have a lot of barrels of oil that can be released onto the market if the investors or the players that are holding oil so decides. Next, we look at how COVID-19 has affected especially transport, fuels, and biodiesel. The chart is a year-on-year change in US weekly fuel demand. You find that different fuels have been affected differently. Of course, at the top there, you have biodiesel. Then at the bottom, we had jet fuel. Of course, jet fuel, we know about the airline industry and transportation. The rest of it lies in the middle itself. So COVID-19 has affected different sectors of the economy differently. Next thing, when you look at the crude oil outlook, you cannot get away from shale production. One, of course, the shale recount has been in a downtrend. We'll look at the chart later. Then pioneers like Chesapeake Energy has not been able to take very low prices of crude oil. And if you look at the chart, this chart is the price of this particular chart is of the WTI, and the darker one is on shale output. You find they are perfectly correlated. When we have a high price of the WTI, we also have high shale production, lower price of the Western Texas Intermediate, low price for low production of shale, and this is what happened in April. So shale companies now at $40 are beginning to increase production, and of course they will be very happy if the WTI price hits $50. The reason why they are able to come on and go offline very fast is that because drillers normally don't shut wells. They just reduce the wells to production at very low capacity. So even companies like that have filed for bankruptcy in the US are still producing, but at very low capacity, and they can ramp up production very fast. But this is quite a capital industry where it's very dependent on bank lending to drillers. So if the banks find that the crude price is not worth lending to drillers, most of the drillers will go underwater. And of course, what I feel is that shale production will not survive in the very long run if prices stay below $30 a barrel. Okay, next we look at OPEC. Of course, OPEC has been especially Saudi Arabia has been the manager for managing the price of oil over the years. OPEC has agreed to cut 9.7 million barrels per day, of which Russia has some share and OPEC has about 6.1 0.084. The key to this is compliance. How well would all the members of OPEC Plus, right, from Russia to countries like Iraq, Nigeria, and Kuwait, adhere to the agreement? Of course, Libya and Venezuela had not been part of the agreement. And what happens to oil there also affect crude oil dynamics. Okay, but going forward, all right, in the next half, and we are looking especially now at August, where the market will rebalance, the surplus barrels of oil will convert to deficit. And for traders, you must always pay attention to the forward structure of the futures curve. Very early in the year, it was in backwardation. When COVID started spreading, the market went into contango, and now we find that the contango has been flattening very well. We find that the spread between each month has narrowed quite a bit. And if the contango goes into backwardation and the forward curve is downward sloping, we know that the market is currently would be in deficit. Let's look at the technicals in the CME August crude. I expect a short-term correction to $35 a barrel for the WTI. Price normally will range for the second half from $35 to $45 a barrel. Primary reason is this: once price goes above $40 to $45 a barrel, you will find a lot of shale producers increasing their production. Okay, there are a lot of factors that can work against rebalancing oil markets. Of course, the primary thing is the second wave and OPEC discipline, and we have a lot of oil that is lying around in barrels. If you look at the chart there, it's the chart of the US rig count. You find that the number of rigs has reduced and is practically bottom out down here. For those who are keen to follow the rig count, Baker Hughes just released its rig count every Friday evening after the US market is closed. So let's look at gold itself. We find this quote from gold, and I like the quote because it reflects what is happening in the market. It says the macroeconomic backdrop will encourage inflows of institutional money into gold over the rest of the year. But the positioning is going to be strategic. What I mean by strategic is that institutions are not going to chase money, or rather the price. They're going to wait until they get a good price, and then they're going to jump in. So his recommendation is more buy on the dips. This is the price of gold over the years. You'll find that it's pretty healthy now. Okay, fundamentals of gold. You find that supply and demand of gold, of course, at different times of the year and different seasons will affect gold prices. We find that mine production for gold supply is down as compared to last year, but the investment section is up. Investment, what I'm talking about is fiscal investment, especially the buying of ETFs, is high. If you look at the gold market balance, we find that the supply is much greater than the demand. And of course, you would say that if the supply is greater than demand, we will see falling prices. But the difference between the two is absorbed by institutional investors. Of course, now we have central banks, because of their monetary stimulus, they need quite a bit of money, and they will not use the money to buy gold. But whatever it is, the institutional side will take up the slack. Okay, we have huge amount of fiscal and monetary stimulus. What it means is that currency is going to be debased, and of course, most of us are aware of the inverse relationship between gold and the US dollar. Over the long run, we cannot have a dollar that is pretty strong as compared because of the debasement of currency. Sorry about that. Okay, next thing, we have central banks pouring a lot of money. What this chart shows, there is a correlation between the growth in the price of gold as well as the central bank balance sheet. And here you find the balance sheet of central banks growing exponentially. Gold primarily is a function of real rates. Real rates primarily is the interest rates minus inflation, the US dollar, commodities, and risk. And if you look at the chart here, and you find that for risk itself, you look at the wicks, change in wicks, change in risk structure, we have gold price going up. And okay, let's look at commodities then. Also, same positively correlated with commodities, negative correlated with the US dollar. And what affects it most are the yields, especially the 10-year yields. Then the next chart is also a key, which is the R-square goodness of fit for real rates. And you find that what affected most is the 10-year real yield on rates itself. Another one which shows a graphic picture of how the Fed policy and the real rates are inversely correlated. Same thing with the balance sheet and the price of gold. Okay, next thing we need to look at is investment demand. There is also a relationship between the investment demand and gold price. And if you look at this chart itself, this is a chart of gold, physical gold holdings and the price of gold. And you find that both move in tandem over the years. So the outlook for gold is that gold has performed very well, and primarily it has mirrored the up and down movement in real interest rates. Okay, investment demand has been the key mover of gold. Okay, you need to pay attention to this downward sloping, which is actually the net long of fund managers as reflected by CFTC. You find although the price has gone up, fund managers are not so keen to go net long in gold. Like I said before, institutional investors are very patient. They rather wait rather than jump and chase the price. The other one is the gold-silver ratio. You'll find that as economies improve, the silver price is going to go up more than gold itself in terms of growth rates. Okay, then we have where the price is going to be soon. What I feel is that although the $1,800 an ounce barrier has been broken, gold will take its time to go up to the 19,000 target and then on to further on. It has run up quite fast, and do feel that it's due for correction, but there'll be a lot of buying on the dips, and the 17,000 would be a tough level to crack. And of course, there are risks that are around for pullback in gold. We do feel that gold will straddle lower before trading higher in a band beyond 1,800. Okay, we do have systematic risk that is lower, but the Fed is committed to policy rates. But if they do mention anything about positive policy rates, it's going to be a damper on the price of gold. Then we also have plenty of gold for delivery in the COMEX futures, and also investors' appetite for equities now. There have been other issues, but the key one is gold is real rates. It's a powerful driver of gold. And from what the central bank and investors' outlook, we would find policies and investment objectives that are positive for gold going forward. Okay, here it's almost time. Okay, let me skip this. Okay, let's go on to my target for gold. Third quarter, I expect 1,900. That's what I'm looking at. In the fourth quarter to 2,000 an ounce. And for 2021, if the current policies remain, which I do expect them, because we don't see a medical solution for COVID-19, it's not going to go away so fast. Let's go on to rubber itself. Rubber is perennial bear for many years because of amount of high inventories and supply. This is the OTC chart of rubber over the years. Okay, world production is going to fall by about 4.5%. Last month, the Association of Producing Countries came up with that it's going to fall by 4.7. They have revised it to 4.5, which is good. There's a lot of rubber now that has been taken off the market, especially in Indonesia, where we find that there's outbreak of the disease itself. The world total will be previously we are looking at 13,130,000 tons. Now it's almost 13,200,000 tons in June. Next, consumption. Consumption has fallen by 7.5%. But the good news is that the worst is practically over, and consumption is going to be positive in the third quarter by 1.4%. India, of course, is a large consumer, is downgraded, so as Indonesia. But China, which consumes about 40% of natural rubber in the world, have scaled up its consumption. From a 20% fall, it is now expected to be positive by 0.8% in the third quarter. Not everything is bad news. This is a chart of latex. I thought it's quite interesting because as far as COVID is concerned, it has been good for latex. You find latex very useful in hygiene and rubber gloves. But primarily most rubber, like the 3-sheet and the TSR20 rubber, is being used in tires. And if you look at the chart itself, we find a drastic drop in sale of vehicles in 2020, then a dramatic rise. Currently is about 12.21 million light vehicle sales in the world. The higher the number, the greater will be the demand for rubber, especially 3-sheet and the TSR20. There's been a marginal improvement in the rubber chart, primarily for reasons that are related to COVID, but we do have geopolitics between US and China affecting the rubber price. Let's look at the chart. This is a chart of the SGX TSR20 rubber. It collapsed in January when China closed up, and it opened up in March when China reopened and has appreciated. Okay, here the Hong Kong issues started, but news of course, good recovery in China is very good for rubber prices. I do expect rubber prices to range from 112 to 140 cents per kg. I don't expect prices to go to pre-COVID levels, but still it'll be positive for April. The short-term outlook is quite supportive of the natural rubber scene. We do have the purchases managers index improving in China. Going forward, economies are opening up, and of course, if crude oil price don't go below $30, it will be pretty healthy for rubber itself. The reason why crude oil prices affect rubber also, besides palm oil and others, is that synthetic rubber, which is a competitor for natural rubber, comes primarily from crude. Okay, this picture is interesting. This is a picture of the RSS3 unsmoked sheet. It's put out to dry. It's normally used in high performance tires. And of course, the factors that are affecting rubber, just like other commodities, are real, right? It's the same factors that affect other commodities, more or less, except for maybe gold. It affects crude oil, it affects palm oil, and it affects rubber. Okay, I've finished my session. Will we have some questions, please?
Thank you, Aftab, for sharing today. There are a few questions. The first one will be, do you think seasonality will put further pressure on crude price? I think he's asking about crude palm oil prices.
Seasonality now has been put in the backseat. Of course, we do have a high production until the end of the year, where we do have rains. But now we need to watch out for the ENSO development, whether the rains will come earlier. If it comes as predicted in the spring of the southern hemisphere, that is in September, which I think is very likely. Just watching from the weather in Singapore itself, it has been a wet June. Normally in June we have very light rains, but this time we actually have rain every day. So we can see weather patterns developing, and it might get into full swing in September. Yeah.
All right. Okay, the next question from Anthony. What are the headwinds from India and Indonesia on palm oil prices?
From headwinds, from India itself, it's primarily the coronavirus situation in India, right? it's don't seem to improve, right? And that of course will affect the demand of palm oil overall. And the other one is the geopolitics between the ruling parties in Malaysia and its quarrel with India. For Indonesia, I think the critical thing is more whether the government there can go ahead with the B30 program, right? The B30 is going to pull quite a bit of palm oil into biofuels, and it is going to affect, if it goes through with it, it's going to affect livelihood of the, or rather it would improve the livelihood of many rubber plantation people. But this program is expensive. Next.
All right. I guess the audience are more interested on palm oil. So next is, why is palm oil always cheaper than soybean oil?
It's the cost of production. You plant a tree, it can last for 15 years. And the fruit, once the tree is grown and is bearing fruit after 3 years, it's not too difficult to maintain. Primarily, you have fertilizer and labor cost. Whereas for soybean, we have a crop every year. And of course, we have all the supply-demand dynamics affecting it. The planting season in the Northern Hemisphere begins in March right until September. And we have weather issues, there'll be problems, and the Southern Hemisphere follows after that. So primarily it's just the cost of production.
All right.
Yeah.
Thank you. I think let's just ask the last questions. What are the challenges that the B20 mandate Malaysia will face?
It's quite a number of challenges itself, because one, with the palm oil priced here at it is here, right, at today current levels, there are definitely going to be challenges. Like I said, mentioned before, the B20 is for any blending program is not cheap to run. The Malaysian government has already removed taxes to encourage the export of palm oil. But it can be done. It requires political will and an improvement, of course, in the coronavirus situation in Malaysia. Of course, there are other politics that are involved in there. We do need a stable government that can decide, okay, we're going to go ahead with the B20 program. It's good for us, and let's get it going. Thanks.
All right. Maybe just one last question. I think the Water just correct the questions that the first question, right? He was asking about seasonality. Do you think seasonality will put further pressure on actually WTI crude prices instead of crude palm oil? So what about WTI?
WTI, it's not so much because currently we do look at seasonality previously, but currently if you look at seasonality, it's more of the demand side of the story. What we are more keen now is most analysts don't really look at seasonality. They now looking at whether how the shale producers going to come in. Will they come in at this price, or will they wait for the crude oil price to go lower? And of course, those people in OPEC, especially in the big traders in Saudi Arabia, they are also keeping an eye of how shale producers are going to benefit, because when OPEC cut production, right, it's the shale producers that actually have benefited. If you look at the history, or rather go through all the production cuts last year when OPEC finally agreed to cut, what they found was in the end the OPEC producers, rather the shale producers, that have really benefited from oil without reducing their production. So I think it's everybody got to get their act together, both the shale producers as well as the OPEC, and decide, okay, we need some discipline, and going forward it will be well for most commodities then. Otherwise, currently with COVID-19, seasonality has been kept in the backseat because of the lockdowns. So most investors actually not paying that much attention to it.
All right. Thank you so much for
Thank you,
after
Hendrik.
the sharing today. Thank you all for joining us tonight. This is Hendrik here signing out. If there's any other questions, you can just email to us or talk to us, and you can keep a lookout for our coming webinar. Log on to our Phillip Futures official website. Okay, thank you so much. Good night.